Uzbekistan started to move to inflation targeting a few years ago, it became a big change for us. The whole monetary framework has changed. We have achieved some results since. So what we did, we have a 5% inflation target. We strengthened our analytical capacity, improved forecasting, and enhanced our communication. The results are visible. From inflation reduced from 20% in early 2018 to 10% in 2023 and 5.5% in May of this year. Core inflation reduced to 5.7% as well. Another important sign of progress is the inflation expectation, which reduced from 20% to 10%, although there is still room to improve. We have to work on that. But nevertheless, we think that the substantial improvement that we're gaining some credibility. And the point is that inflation target itself, the inflation number itself, is not, should be considered the only number we have to focus on, but we have to focus in our case in Uzbekistan on how people and businesses changing their behavior. And for us, one of the good signs of improving credibility is the level of de-dollarization. The de-dollarization since 2018 reduced. For example, for deposits, they reduced from 50% to 20%. In the loan, the dollarization reduced from 54 to 37%. And our research suggests that it's not just cyclical movement, but it's really structural changes, improving confidence in national currency. The households and the businesses are prefer to work in national currency, place deposits, take a loan in local currency. And this reflects that credibility started to improve. And the second point in our case is that economy which is undergoing structural reforms obviously will challenge the monetary policy. It creates a lot of challenges for us because all of those reforms are focusing on liberalization, especially administrative prices. They are being adjusted each year in different sectors, and all those are putting some challenges for central banks, of course. Those reforms, we have to understand that they are essential for the long-term growth and to improve productivity in general. And the central bank's role here is that to let those necessary related price adjustments, but to focus on not letting them spilling over to the wages, expectations, and the broader pricing. So that's why in our case, the monetary policy itself can contain probably the second round effects, but overall inflation cost depends heavily on on how structural reforms are going and the fiscal policy are sequenced. That's why predictability and coordination can reduce the economic cost of this inflation. And in emerging economies which are undergoing reforms, this is a very important. And the third is that central banks must modernize continuously if they want their framework to remain effective. First of all, in our case, it's transmission mechanisms have to be strengthened. Policy decisions need to influence the market rate, saving behavior, credit conditions. We have to focus on deepening financial markets and continue our banking sector reforms, which is remain important priorities for us. And the second, in our case, is exchange rate flexibility is essential. We believe that for the small and open economy, the exchange rate serves as a shock absorber, and it's vital for us to make sure that it's flexible and fully floating exchange rate is while it's not the target, the exchange rate itself, but it supports our inflation targeting regime. So from Uzbekistan perspective, I think credibility is better built during exactly this. Help us to build better credibility. Thank you very much.
Thank you, Governor. Your introductory remarks, please.
So thank you very much, David, and let me also say it's a great pleasure to be here, and thank you very much for the invitation, and let me congratulate the Governor and his colleagues for what has been and promises to be an excellent event over the next few days. I mean, as others are facing central banks, surrounds how we deal with this rise in volatility. Small open economies, volatility emerging from the global stage. Recent events in the Gulf are another example of the type of supply-side shocks to which we're subject. But that's not new. It's something that has come through over the last few years, as on these slides. And indeed, for the UK at least, the current shock is not necessarily one that is big in terms of magnitude. Nonetheless, it is another challenge to the management of the UK economy in the aftermath of several challenges over the past few years. So I will say a few things about the UK experience here. The UK has been running an inflation targeting regime for more than 30 years at this point, generally very successfully, but in the face of some of these shocks, inflation did depart quite significantly from our 2% target in 2022-2023. And that's led us to review our practices and consider how we can improve our own framework. So we asked Professor Ben Bernanke, who will be well known to many of you, to conduct a review of our monetary policy process. And although he made several recommendations, at the heart of his recommendations was increasing use of scenarios in assessing the rising uncertainties and risks which have become obvious in recent years. So if you could go to the next slide. Using scenarios is not new. It's not new for the Bank of England. It's not new at other policy institutions. But as others have said, I think using scenarios for external presentation of monetary policy decisions is a more novel experience and one that I think we are still experimenting with. Nonetheless, in the face of recent events in the Gulf, we've set out the framework that is captured in this slide, where we've tended to focus on two forms of uncertainty. On one side, as Governor Schlegel said, the impact on energy prices, which clearly has a big role to play in the UK economy and the UK inflation outlook, where I think we've tended to characterize that uncertainty as quite radical in character. It's very difficult, has proved very difficult to forecast events in the Gulf. And even though news there has been more positive of late, I think there remain continued uncertainties and difficult to forecast uncertainties. But we've also emphasized uncertainties across how that energy shock will propagate through the UK economy, ultimately to consumer price inflation, which is our target variable. I think on the back of events, we are studying that closely. We think that is a much more learnable process to understand the transmission and propagation of these inflationary shocks in the UK economy. But what we found is that different members of the Monetary Policy Committee hold different views about how that will work. And in particular, as others have said, on the strength of the so-called second round effects, that self-sustaining momentum in domestic wage and price inflation triggered by developments in energy prices, but not of themselves driven by that. So this scenario framework, which we are experimenting with, has come with a number of pros and cons. So I'll just list the pros and the cons as a basis for subsequent discussion. On the pros side, I think thinking about policy challenges in the form of scenarios has improved the quality of internal discussions within the Monetary Policy Committee. And in particular, I think it's defined a space, perhaps captured by this matrix, where that learning that Athanasios was talking about in his presentation, in the face of imperfect knowledge about the economy, can take place in a structured way. This type of framework, this type of matrix, allows us to accommodate and consider a greater variety of views than will be captured in a single model. And it's given a setting in which those can be articulated externally. And perhaps crucially, that framework has allowed us to consider different types of risk, not just risk that can be easily captured in the form of probabilities, but also risks that may have this more radical and uncertain character. And that's helped us think about policy in the way Governor Schlegel described, not as an optimal policy in the face of a relatively narrow, well-defined set of risks, but rather a robust policy that is able to perform well across a broader range of uncertainty in the uncertain and volatile world we face. But I think it's also fair to say, as others have hinted towards, that the use of scenarios has come with some challenges. One challenge at the Bank of England is that we have 9 members of our Monetary Policy Committee who are all individually accountable for their own vote on the monetary policy decision. And by having the use of scenarios, I think we've tended to encourage members to focus on their own view, seeking to have their own scenario, which to some extent comes at the detriment of the collective view of the committee, which ultimately drives the final decision. I think, as others have also said, using scenarios adds some complexity to the policy process. I think for technical experts in markets and academia, that is to be welcomed as a form of transparency, because we are facing a complex world that needs a more robust solution for policy. But that can come at the expense of the clarity of messaging for the wider public, the general public, and the type of focus and so forth that Athanasios mentioned. It's also true, I think, that the use of scenarios has tended to focus on a relatively narrow set of issues. So our recent communication of monetary policy has really focused pretty narrowly on how we're dealing with the consequences of events in the Gulf. But there are always other challenges out there, and I think that the challenge of making sure we have the breadth of opinion, the breadth of approach, where challenges emerging externally, one might point to El Nino as another form of challenge for commodity prices and so forth, or challenges emerging domestically, be they fiscal or political, I think is also a risk. An issue around using scenarios adds to the dimensionality of the monetary policy problem. In our most recent report, we did not have a central baseline forecast in the manner that Governor Schlegel described. We had 3 different scenarios, each treated equally. So if you're doing analysis around 3 different scenarios, the number of implications for policy multiplies. And I think I have a fear that that may create a menu of possibilities that creates a more discretionary approach for individual policymakers rather than focusing on the systematic approach that Athanasios was emphasizing. And then finally, and as I intend to capture in this chart that is now being shown, I think there are some dangers that if you have a scenario that is quite extreme, it is interpreted by policymakers as a sort of different world, a different story. In this picture, a second mode in the distribution of possible outcomes, where policymakers might decide to say, if we get into a difficult period where inflation is really rising, we will act aggressively in that world, but we will wait until we see it. And in the world we live in, where that risk is still there, it may encourage some prevarication in actually implementing that robust approach that can contain these upside risks. So the way I would sort of conclude is to say, and echoing words that the Governor has mentioned himself, I think designing monetary policy frameworks and using them within an inflation targeting regime is a never-ending journey. In dealing with using scenarios, we want to accentuate the pros that I've listed and manage and minimize the cons. I think that points to me to focusing on the everlasting verities that both the introductory video and Athanasios emphasized. Price stability, as encompassed by an inflation target, creates the environment for investment, for growth, for dynamism and innovation that ultimately raise living standards. But in order to achieve that inflation target, the monetary policy framework does need to evolve to accommodate the changing global and domestic economy.
Thank you. Professor McMahon, please.
Okay, thank you very much. Again, thank you to our hosts and the Governor. It's been a wonderful trip so far. Uncertainty is real and affects even academics. I knew I had to speak after Athanasios, and I know he and I share some similar views, but probably some differences, so I had to decide what to say. I was extremely happy that what I was going to say aligns quite a lot with what Athanasios says. I have sort of 2 or 3 key points that I want to make, which is really lessons from the theoretical and empirical research on central bank communication. So I guess to put it, the first one in very trendy terms, given where we are in time, whether or not forward guidance will be with us for the future. The second is something I sort of refer to in my own research as monetary policy is a team game. Namely, it's not just what you do, it's also that people out there in the markets and in the household and business sector, they understand what you're doing and why, and sort of, again, the foundations of the video we saw made that clear. And the last is a comment which I think is particularly relevant to make because Governor Schlegel mentioned the risk management approach, and in the last week we lost Alan Greenspan, and I think he is in many ways the kind of central banking risk management godfather in terms of at least how we think about it. So let me make a few points. I can make this very quickly. As Athanasios said, our models, which we use, and I like our models, and I too am a modeler, they do assume a lot of bits of communication are already built in. I mean, there's really fundamental, deep understanding of the structure of the economy, the way policy behaves, all the shocks that hit the world, and there's no, in standard models, disagreement. Why am I saying that again? Well, because if you want to ask the question about forward guidance, and especially explicit forward guidance, in lots of our standard models, explicit forward guidance is the only communication game in town, and it's very powerful. My argument is not that, you know, it was always a mistake to do forward guidance, but I think it's been overemphasized in both the theoretical discussion of optimal monetary policy, but there is a role for it potentially at the zero lower bound, but I also think the main lessons from our models are knowing what is already assumed, and that is you want your public and your financial markets to understand what your objectives are, to understand how you're viewing the world, and to understand the risks you're facing and how you're taking those on board. So, you know, I think, and again, we discussed this, some of us a bit earlier, there's a concept of a reaction function. In our models, it's a very specific thing, but in reality, it's how you're thinking about the world and how you will adjust policy. I think making that clear is really vital, and that should be sort of one of the first objectives of communication of a central bank, and that's one of the ways that inflation targeting helps. The second is people understanding your assessment, nowcasts and forecasts of the world. I think that is important, but also the uncertainties around that. And again, I don't doubt that there are some situations where explicit forward guidance could work, but in general, I think it has been overemphasized, and that we should sort of focus on the first two. The second team game idea is that actually what really matters for people's decisions are not the central bank rate, but other rates in the economy, 5-year, 10-year, 20-year rates, varying by country depending on your mortgage market. And we know from the study of these things that the central bank's actions are part of what drive those interest rates, but so are their words. But not just that, it's not just those expectations that matter, it's also, as Athanasius also said, it's also risk premia that matter. And so in a series of recent work, and I know there's a lot of members from Poland here, my Polish co-author Anna Cislak and Hao Pang and I, and a series of papers have looked at the evolution of risk premia in moments where the market becomes uncertain about the central bank. And the lesson actually comes from the Federal Reserve, arguably one of the most credible central banks. But in the last 5 years, they did experiment with this move to flexible average inflation targeting. But in doing that, and again, in our models, this is a very powerful extra dimension to monetary policy for an economy facing potential challenges of a low neutral rate of interest. In practice, what we show in this work is that the lack of clear communication about what it meant. There was an unwillingness to describe how long the averaging period would be, how much inflation would be allowed to potentially overshoot. We show that there was a growing uncertainty about what the Fed's reaction function was. How would they react to things? And of course, it came at a difficult time. As the economy emerged from COVID, we saw growing inflation pressures. We saw an active debate on whether this was transitory or permanent, whether it was supply or demand. And so it was a highly uncertain time combined with an uncertain central bank. And what we show in the paper is, although the Fed's lower for longer promise was very credible, 2-year expected interest rate moves were exactly flat for at least 18 months. In that same period, long-term interest rates rose by about 150 basis points, driven largely by estimates of the risk premium. And we in the paper directly linked this to Fed events, communication events, and growing macro news. So there's a famous quote that comes from Ben Bernanke, which is that monetary policy is 98% talk and only 2% action. Most people don't read the rest of that opening paragraph, where he says, the cost of sending the wrong signal may be large. So again, in a world with term premia, you have to think as a central banker, how are the risks? How am I eliminating the risks that are related to my own potential behavior? And so, I talk about a team game, as is always the case when I get excited about calling something a team game. I discovered that Ben Bernanke in 2003 called it a cooperative game, and so he beat me by 23 years in that. I do think that explicit forward guidance can be constraining, and that constraint, or the appearance of being constrained, can undo your intended policy. Like I say, the Fed wanted lower for longer, but long-term rates tightened by 150 basis points over that same period. Just to finish with my last point, I do think in all of that, I think this understanding of risk management, and Hugh has mentioned it, Governor Schlegel has mentioned it, this idea that you think about lots of different things, and again, not in the technical academic sense of robust monetary policy, but in the more general, something that is broadly going to deliver the objective is exactly the right strategy to pursue, but it does require a staff and a policy-making environment where there is a flexibility, there's an open debate and a good discussion of all these things, because you can, as the saying goes, you can take 2 economists and you get 3 opinions, and so we should embrace that. I'll stop there, thank you.
Thank you very much. Nice ending. Professor Sakina, please.
Okay, so, well, first of all, I'd like to thank the organizer for having me today. This is such an honor for me to participate in this important event. And David asked me to talk about digitalization in Japan, but instead of narrowly focusing in digitalization in Japan, I'm going to talk about the design of the digital currency more globally in order to broaden the scope of the discussion. So digital currency is a hot topic among central bankers. And the topic is one of the highlight of my central banking lecture course at Hitotsubashi University. And by the way, this lecture course is provided to central bankers in the Asia, including those from Central Bank of Uzbekistan. And this is such a rapidly evolving area. I need to update my lecture material each year. The past year has seen clear divergence between two major regions in how to design their digital currency. Stablecoin in the United States versus the central bank digital currency, or CBDC, in the euro area. On the one hand, the United States enacted the Genius Act in July last year to regulate and promote stablecoin. And the executive order in January prohibited federal agency, including the Fed, from developing and issuing a CBDC. On the other hand, in October, the ECB announced a plan to launch a CBDC in 2029. And the European Parliament began the relevant legislative process. So the United States has steered itself toward the stablecoin and Europe toward the CBDCs, although the further twists and turns cannot be ruled out. In this context, Japan is prepared for both paths. Japan was the first in the world to introduce stablecoin legislation. The Bank of Japan is advancing its CBDC pilot program, and the relevant ministry and the bank are working to develop a design outline for the CBDC. But in other words, Japan has not decided which way to go. And my take is that it may well go the third way. Let me explain first my reservation or concern about CBDC and stable coins. As for the CBDC, it seems difficult, at least to me, to attract general usage unless there is no financial stress. CBDC launched in Caribbean islands have failed to gain widespread use, and their issuance has remained a small fraction of the banknotes. In China, the digital yuan, or digital yuan, which has originally been issued as central bank liability, was recently recast as commercial bank deposit, allowing it to accrue interest. As for the stablecoin, I share many concerns by various commentators, including singleness, interoperability, integrity, and so on and so forth. I will not go through all of them, but let me raise 2 points. First, creating stablecoin, if they are well managed, are making narrow banks or central banks. Think about the balance sheet of stablecoin issuers, for instance, in the United States. Their asset side should be super safe asset. That means that the US Treasury. And their liability side should be stablecoin or money in digital form with capital for the residual. Some may say this balance sheet is narrow bank. My understanding is that the narrow bank is desirable for financial stability, but not profitable. If it were profitable, something dodgy would be going on. Others may say this is a central bank balance sheet. Then it is not clear, at least to me, just like an ex-central banker like me, why a country needs another central bank. Imagine that this second central bank's money is more widely used in society and outperform the existing central bank money. Then who will conduct monetary policy in what way? This may sound like science fiction, but this leads to my second point. The outperformance of stablecoin over existing money may become serious concern for some emerging market and developing economy. BIS estimate that about 90–80% of stablecoins are dominated in the US dollars. A major one is Tesla's USDT, which does not comply with the stablecoin laws in any major jurisdiction. So a significant amount of them are supposed to be held outside the United States. Stablecoins provide access to US dollars and are an attractive store of value, at least for some emerging market and developing economy. Some say this is another form of dollarization. Against this background, the Bank of Japan seems to be trying another form of the digital currency, which is tokenized deposit. That is, have been advertised by the BIS for some time. In March this year, the bank announced its plan to explore the possibility of the tokenized current account deposit at the bank, so-called wholesale CBDC, as a central bank money. The bank is participating Project Agora, a cross-border payment project in which 7 central banks and over 40 private financial institutions are collaborating to explore the potential of new interbank settlement system that utilize tokenized bank deposit and central bank money. That said, they are still in the early stage of development, and we do not yet know how tokenized deposit work in practice. And I would like to add one more way taking place in Southeast Asia. In the region, they have been actively connecting their quick payment system to one another. For instance, these days, Singaporeans can travel to Thailand and use their smartphone and QR code settlement to shop and dine there. I might be wrong, but imagine that situation where click or pay me, that is, I saw that which is widely used in Uzbekistan, can also be used in Kazakhstan. This must be convenient, isn't it? And I sometimes think that if this technology had been available more than 30 years ago, Europeans would not have introduced the euro, as they could have traveled all around the euro area without any hassle of exchange money here and there. And more importantly, without surrendering their own independent monetary policy. And I do not know which way Uzbekistan will go. That means that stable coin, CBDC, tokenized deposit, or broader connection of quick payment system of neighboring cross-border connection of quick payment system of neighboring countries. There might be even the fifth way. All I can say is that we need to keep eyes on development in this area, especially the US stablecoin initiative, as they might affect your countries through digital dollarization. I will stop here. Thank you very much.
Thank you, Professor. Professor T, please.
Well, first of all, I'd like to thank the Central Bank of Uzbekistan for the opportunity to speak here and the superb organization of this event. So as was already explained by several panelists, the current situation has been for many years very unique in terms of high uncertainty of shock. But it's more than an uncertainty of the standard demand and supply shocks. We also have new types of shocks. If you go back 10 years, someone who talked about geopolitics and economics, that would be, okay, that's interesting, but no more. Now it's very central, and we're starting to see in research that geopolitical shock starts influencing things such as the use of currency in international trade. So it's a very new type of thing. So in my remark, what I want to do is go over some implication for the macro economy, the link but the general public, you don't want to overwhelm them. And there is the issue to bear in mind that nobody is perfect, and central banks sometimes get their forecast wrong. When you look at the forecast of inflation during the cycle, it was a surprise to many. Well, shocks by definition is something you don't expect. So that it's okay, but also to be realistic to the public and say sometimes we get it wrong, but then to communicate how we adjust like this. The image I like to go is, if I break my arm and I go to the doctor, I'm not going to blame the doctor that he didn't tell me I will break my arm. That's not what I expect. What I expect is the doctor to be able to heal me once my arm is broken. So to have communication of what central bank can and cannot do, and then to avoid instilling unrealistic expectation from the public. Okay, thank you very much. I conclude here.
Thank you very much, Professor T, and I would like to thank all the panelists for excellent introductory remarks. In the follow-up discussion, I see a few areas forming, and maybe the first one we could start with is about the current risks and the implication for policy. So let me first start with Mr. Lee, and in your introductory remarks, you mentioned several important ingredients of good policy, starting from independence, having good right analytical framework, working through scenarios important for decision making under uncertainty, and as well as very effective communications. Now, thinking about the most recent shocks, thinking of how does the IMF view the global outlook, and what are the key considerations for monetary policy, how to handle and navigate this shock wave that we have just experienced?
Thank you, David. Well, in April, we had our latest issue of World Economic Outlook. In that outlook, we had three scenarios. We had what we call the reference scenario. We have the adverse scenario, and we have the severe scenario, very similar to what Bank of England is doing. The reason we had three scenarios was precisely because the uncertainty was so high. We were in the middle of the latest war in the Middle East, and it only started at the end of February, and we had to produce the latest edition of World Economic Outlook under great uncertainty. So that kind of is unprecedented for us to present. Instead of one baseline, we had three scenarios. And of course, after 2 months, now at the end of June, we see that there is a ceasefire, there is some MOU signed. It seems that some of the worst worries may not be happening. We still don't know, but the market is quite sanguine, maybe sometimes too sanguine. But the oil price has come down. I will say that right now, based on the key indicators, we are closer to the reference scenario, which is the most benign among the three scenarios we had. And in that scenario, we predict average oil price of around $80 per barrel. We had a forecast of 3.1% for the global growth, and global inflation of 4.4%. And of course, as I said, this is a global picture, but the impact is quite uneven, right? U.S. is doing well, some of the oil exporters are doing well, but some of the developing countries and emerging markets are facing a lot of challenges, including some of the low-income countries facing high energy price and fertilizer price. So what does this mean for monetary policy? So in April, in our will, we said that for some economies, because it's a supply shock, they could afford looking through, or at least wait and see. Given that it was still early in the conflict, and inflation expectation was still anchored. So some economies can afford to wait, to look through, because that's a standard textbook lesson, right? When you have a supply shock, especially if it's temporary, or even permanent shocks, excuse me. If it's a one-off shock that central banks can look through. However, for some developing countries, and the emerging market, excuse me, their central bank credibility is limited. And for them, looking through can be difficult. So our advice has been that when countries see significant risk of inflation expectation de-anchoring, then they should act. They cannot wait. Because you cannot wait until the inflation expectation become actually de-anchored, because that would be too late, right? So for some countries, especially countries with limited central bank credibility, our advice has been that you can act, you can react, you can start to act, even though it is still early in the conflict. So the advice is that country has to think about their country-specific circumstances and think about the danger, the risk of inflation expectation become de-anchored. So let me conclude by commenting on the risk management approach to monetary policy, because Governor Schlegel mentioned that, several commentators mentioned that risk management approach. We think it's quite appropriate given the current environment for countries to learn from this approach. But what does it mean to have a risk management approach of monetary policy? I think there are several elements that are important for a risk management approach. One, risk tolerance. So what is the risk tolerance for central bank for inflation? I would argue the risk tolerance should be very low, right? Because central bank's main job is price stability, right? So the risk tolerance for inflation expectation become de-anchored. The risk tolerance for actual inflation should be very low. That's number one. Number two, you have to do scenario analysis, right? Because it's, what do we mean by risk management? Risk management means you have to think about different risk scenario and think about in each scenario, what is your response? What is risk mitigation? And even though you don't have to communicate all the scenarios, you have to at least internally think about it. Right, that's the second implication for that approach. The third implication is, as I mentioned, what is the decision rule? The decision rule should be that if there is significant risk of inflation expectation become de-anchored, central bank should act. Central bank should not wait, say, okay, let's wait until the inflation is actually going up, or until the inflation expectation become actually de-anchored. Because if we wait until then, it's too late. It's too late. And by the way, some of the measures of inflation expectation are also quite unreliable, as we have seen in 2022, right? In 2022, we see some of the measures of inflation expectation, the medium-term 2-year, 5-year inflation measure, the market-based inflation expectation measure, they're quite unreliable because they prove wrong in the end, right? So you cannot rely purely on market-based measure of inflation expectation. And given all that, the risk management approach means that when central banks think there is significant risk of inflation expectation become de-anchored, central bank should act. So that, to me, that's the meaning of a risk management approach to monetary policy. I stop here.
Thank you very much. Central banks should act looking through the shock can be difficult and perhaps even dangerous. This could speak to some of the words that Athanasios highlighted in his speech about, becoming less flexible rather than more flexible in adopting inflation targeting frameworks can be an important guidance for the future. Dr. Pill, may I now turn to you? With this perspective, you spoke on many occasions about inflation process itself, inflation formation process. We heard about expectations, how important it is, and sometimes difficult if you don't have credibility. And you said that you believe inflation, or there's evidence, of course, that inflation is becoming more persistent. And if that's so, what are the lessons that central bankers should take or policymakers should take, given this new era of uncertainty in handling various kinds of shocks, especially supply shocks, of course? Please.
So I agree very much with what others have said. And in particular, I think, although there are good intellectual arguments for looking through in the face of temporary supply shocks, and recognizing the benefits in a certain world of flexible inflation targeting, which is part of our formal remit in the UK, so it's hard to distance ourselves from it too much. But I do think, as has been said by others, there are reasons to emphasize the primacy of the price stability objective, the attainment of the inflation target. I think many of these points have already been made, and maybe I'm going to say there are three issues, but they're the same issue just expressed in different ways. The first is, I think it's very difficult in real time to know what the shock is. So unfortunately for policymakers, including central bankers, shocks don't come with labels. And so understanding where we are becomes, and how we are being disturbed, becomes a key issue. And I think Michael, for example, emphasized the importance of nowcasting and trying to communicate what we know, but maybe it's equally important to communicate some elements of what we don't know as well. And I think that definitely limits the scope to implement a flexible inflation targeting look-through approach in practice. The second, as many have emphasized, is the role of expectations. I think we have had a lot of emphasis on stabilizing long-term inflation expectations and the benefits of doing that, and I very much agree with that. And the primacy of trying to ensure that is maintained in difficult circumstances is key. I think the central banking community should take some satisfaction from the fact that in the face of greater supply disturbances and volatility over the last decade, we haven't seen a falling back to the experience of the 1970s, where I think inflation expectations at the longer end did become de-anchored. But of course, I don't think we should be complacent, because we haven't managed to keep inflation close to target in many jurisdictions, including in the UK. But I do think there is a kind of question here, and it was exactly what Mr. Lee just raised, is what is the best real-time and most relevant real-time measure of expectations? Looking to longer-term financial market-based measures, maybe markets rely on central bankers and then central bankers rely on markets. There's a sort of hall of mirrors type behavior there, which can be a little bit destabilizing if we get shocked off that sort of healthy, self-reinforcing equilibrium. I think one of the things we've learned in the UK experience is that more emphasis on household expectations, firm expectations, and maybe short to medium expectations. These seem to play a bigger role in the pricing process, and they seem to play a bigger role in generating that initial momentum in inflation that can become more self-sustaining. And I think back to what the governor mentioned about the challenges Uzbekistan faces in implementing structural reforms to improve the performance of the economy. Those structural reforms may be necessary and important, but they do complicate the process of understanding the behavior of the economy and therefore the transmission process and the propagation of inflation shocks. And I think in the UK, very different setting, but for example, the structural changes to our labour goods markets wrought by Brexit, for example, are things we're still learning about, we're still digesting. My own view is that those changes have led us to a structure which is more prone to this sort of self-sustaining momentum in pricing, which can lead to greater inflation persistence. And then third, as has been said, I think there is an issue about how we deal with permanent supply shocks. I think the seminal work of Athanasios looking at the drivers of the great inflation, which he should talk about rather than me, I fear, but the fact that for a long period there was an overestimation of trend potential growth, which continually led policymakers to think there was more slack in the economy than there was, and well-intentioned policymakers therefore ran monetary policy looser than we know ex post would have been desirable in order to preserve price stability. I think that's an example of maybe the need to focus on inflation, perhaps have less flexibility in your flexible inflation targeting regime, focus on stabilizing expectations, because the risks if inflation get de-anchored and the costs of correcting that through time can be very large.
Excellent, thank you. That seems a very clear message for central bankers and monetary policy in general. Let me now turn the discussion towards the frameworks and monetary policy frameworks that we use to formulate good monetary policy. And I will turn to Governor Ishmetov now. We heard the CBU's ambitious journey to implement inflation targeting while navigating higher volatility and digital transformation. But in your speech, you also highlighted one other aspect that should not be forgotten, and that's underlying structural change that is huge in the context of Uzbekistan, moving towards the market economy, liberalizing prices, but not only prices, many parts of the economy. Now, taking this perspective, Governor, of an emerging market economy and these challenges and having this inflation targeting ambition, how do you see, what are the lessons from this journey that you would like other similar emerging market central banks to take away? How they should adopt their policy frameworks? Should they follow strict routine, or should they be more flexible, perhaps in certain areas? Please.
Thank you very much. Well, since we started, the overall Uzbekistan started all the reforms 8-9 years ago, and we started adopting inflation targeting. A lot of changes happened in the world and still continues. And one thing probably which we can learn from our experience is that we probably have to, as a lot of colleagues mentioned on different scenarios, is that for monetary policy framework, I would keep this precise target objective, but I think we have to focus on different scenarios, and instead of focusing on kind of achieving this inflation itself, probably we have to now look at what can be the worst case scenario, or what can be what kind of negative effects we can have in different scenarios. And instead of focusing on one kind of the target itself is for the price stability, probably on top of that to focus on resilience and robustness. So to make sure that even in the kind of worst case scenarios that we can be resilient, that can be robust, and we can went through all these worst scenarios with the least damage. But at the same time, keeping kind of our target as a main kind of anchor target and continue to moving toward that direction. If you add on top of that all these reforms and challenges which reforms brings to us, it's actually becomes more plausible in our case is that we have to focus on robustness and resilience in different scenarios and making sure that we will not deviate much, a lot from our target, given that any scenario can really be in place in our life. Thank you.
Thank you. Professor Tay, I now turn to you. You studied a lot of transmission of shocks, you studied a lot, you understand a lot of the emerging market frameworks and policy frameworks. Now, if we imagine the current world deglobalize or trend to deglobalize, what implication it has for the frameworks, policy frameworks in emerging market economies? Are they becoming perhaps more independent? Because the shocks will not be transmitted as fast. Is there a room for more monetary policy, therefore a room for more monetary policy independence for smaller economies? Or this is not the right way to think about a problem? It might be that they're maybe less directly connected, but once the shock transmits, it's actually very nonlinear, as you mentioned in your introductory remarks, understanding nonlinearities and how they may affect and spill over to expectations, and that may be anchored very quickly, as Dr. Bill and others have said. So they should be more on the lookout. What kind of lessons, in terms of in structuring their policy frameworks, smaller central banks should take?
Thank you, David. So I think that the globalization topic is a real one. Will this make emerging market more independent? I don't think so, because these are by nature economies that are highly integrated in world trade. If we take the case of Uzbekistan, gold production is a very big part, and this will, no matter what, remain connected. What concerns me about the deglobalization, it's not something that if it happens, would happen smoothly. It's more that we have shocks, that suddenly block things. So I prefer to think in terms of bottlenecks. We saw it in COVID first, that this could happen, suddenly everything stops. We had the closure of the Strait of Hormuz, which is still not very clear where this is going. And then at least I learned that a lot of, fertilizer ingredients were going through that. So you get this very strong bottleneck, and this is in the physical realm. You can have bottlenecks in financial markets. Suddenly, usually in crisis, you discover that there is one actor that you haven't really paid attention that suddenly is central. So my concern about the deglobalization is more that it brings a new source of risk. So if anything, more volatility. And then the reality, how to cope with that is, as was saying, time to have various scenarios, to have kind of a what-if approach. Okay, what if this happens? What do we do? While at the same time remaining focused on what your core mission is, which is price stability. So if I step back a couple of years, the central banks starting doing a lot of things here and there, which were legitimate thing, but I think it's important to bear in mind that it's not because something is relevant, it's the central banks to handle it, so that the central bank should be very focused. And this, in my view, has a couple of implications. The first one was you need to have an eye on expectations, as was said many times. Now, our indicator of expectations are still imperfect. They're way better than they were 10, 15 years ago. There's been a real progress. But then the question is, how do you know that your expectations are becoming unanchored? And not only you don't want for it to happen, you don't want to wait for it to happen, but also you have to have a kind of a threshold, like, okay, what would have to happen in which metric for me to think that I'm really going into a risk of design coding? Because these things happen very gradually, so there's always a risk that you think, oh, it's not that different from yesterday, so what's wrong? And I think one thing that can be promising there is not to just look at the mean expectations. We have now very rich data on inflation expectation, and you can compute the distribution. And it could be that to focus, okay, if you start having a right tail that develops, this is what you want to be reactive about. So that would be how we take expectation. Structural aspects, so as I said, as a central bank, you're limited on what you can do. And one aspect says that the central bank that cannot do look-through. Well, you have to be tough, you have to bring inflation down. You may overdo it, because you never know in real time. You will get a lot of pushback that you push the economy in a recession, or supply shocks like, well, sorry, but I cannot prevent the recession. But there, brings the issue of a recession are usually very unequal. Okay. So I think it's important to also be able to coordinate policies. If there is a central bank has to take an issue that falls heavily on poor households, to have a social safety net that can there. And this has to be cooperation without going into some kind of fiscal dominance. So I think also that building a memorandum of understanding with the other actors in the country is crucial, to be clear who does what should bad things happen.
Okay, excellent. Thank you. I think the risk of expectations, how to understand them, how to measure them, and how to understand what kind of shocks we're having is, of course, central to credibility, and therefore this opens door to the next area that I felt was echoed very importantly in the first introductory speeches and remarks that panelists had. So turning to credibility and communication in these uncertain times, I turn to you, Governor Schlegel. Just a few numbers I'll start. Post-COVID, Eurozone inflation exceeded 10%. UK peaked above 11%. My own country, Czech Republic, 17%. Switzerland, 3.5%. I liked very much your introductory speech and remarks, and the way you spoke about the baseline, using single baseline, not to confuse, to focus on the message, not to confuse with the public. I think that quite nicely contrasted with experience that Hugh mentioned in the Bank of England, trying to communicate more using different scenarios, which interestingly disciplines more internal debate, makes people more responsible, but exposes the risk of being perhaps less focused and diluting the message outside. So getting back to the numbers, is it just because Switzerland is so exceptional and safe haven, or is it something more? So what is it that others could learn from Swiss experience regarding policy credibility and communication in this time of uncertainty? Thank you.
So, thank you for the question. So 3.5 looks good in the international comparison, but we were not happy with 3.5 because it's clearly above our target of 0 to 2%. But there are two main reasons why we had lower inflation. One is just the composition of the CPI. If you look at the CPI, energy, the share of energy is much lower than abroad. So in Switzerland, it's around 3%, for example. Fossil fuels, or in the other countries it's much higher. So this had already an effect that we had lower inflation. And then the more important one, of course, was monetary policy. And there we really have a lot of flexibility in a way, because we have a target range first, and second we also have two instruments at hand. So we have the interest rates on the one hand, and we also have the exchange rate at the other hand, and we can use both instruments flexibly to achieve our price stability target. So what did we do after COVID? The first thing was that we stopped to intervene to dampen the appreciation of the Swiss franc, so we let the Swiss franc appreciate. And this already had a quite significant effect on inflation, because a lot of the CPI basket in Switzerland is actually imported. But then, of course, we used the more traditional instrument, which is the interest rate. And there we had the record low interest rates before. We were at minus 75 basis points. We hiked them quite quickly, decisively, to 1.75%. But this was not enough. And at the same time, we started to sell FX. So we intervened on the other side of the FX market. actually to make the Swiss franc appreciate. And there we also acted very decisively. So in total, we sold 150 billion countervalue US dollars in the FX market. And just to give you a sense what this means in Switzerland is a little bit less than 20% of GDP that we intervened to fight inflation. So and these two instruments together were really very effective in bringing inflation quickly into the target range again. And at the time, it was really also important that we act early, act decisively, because waiting has no value in such a situation. Because if you wait, then you have to do more at a later stage. Thank you.
Thank you. Acting decisively. I'm now turning to Professor McMahon. You have obviously spent a lot of time studying the FOMC communication and their other ways, or communication of other central banks and their committees. Now, I'll have maybe a provocative question, thinking about today's communication or media world, and thinking about the incessant stream of communication, short snippets. Is it at all possible for the central bank to keep up and to be visible, or should it maybe step back and use that as a way of reinforcing its just core messages, or should it keep flooding the public space to keep up? And is it at all possible for central banks and their communication departments to keep up?
Okay, let me answer it in a slightly long-winded way, but the summary is going to be, it really depends a little bit on your audience. I think historically central banks had a single core audience, which you could describe as the kind of complex financial markets. I'm putting academics to the side. We study it, but the target was to get financial markets on side. They remain a core audience, but I think we've increasingly seen central banks trying to get messages also to a wider community. So it's come up in the discussion, households, firms, etc. And ultimately they're the inflation expectations that matter for most economic decisions. So you asked if they should deliver core messages or flood them. I think they should flood them with core messages. So I do think that sort of getting across a sort of commitment to the inflation target really remains a sort of an ideal thing to do. Now there are other things in work that when we first started doing it, people weren't really looking at this, but now I realize it's a decade old. But Andy Haldane and I have sort of talked about what we call the 3 E's of communication with the wider public. That's explanation, engagement, and education. And so I think all of these matter. Explanation is the one that says, use a description of the world that people can actually gather some messages from. So the average person, if they sat in a central bank meeting about policy, would not have a clue what was going on. In fact, even in a relatively well-educated place like the UK, the average person does not properly understand the distinction between, say, GDP, output, terms that we use a lot, and also things like even inflation, they don't fully understand, but they do understand concepts like jobs and prices. So I think there's a big challenge for central banks, that there's a trade-off between precision, which is where central bankers and academics like to live, exactly precise terms, and accessibility, which is who can actually understand what they're saying. And that's a decision that central banks have to deal with on the explanation side. On the engagement side, I have some very sad news, which is that when things are going well, people aren't that interested. They would much rather watch YouTube videos than hear central bankers tell them about the inflation outlook. When they become engaged is exactly when you're not achieving what you should achieve. So if inflation hits 10 or 11%, or I guess 3.5% in Switzerland, people become upset and they start to look to the central bank exactly at the moment where they are, facing difficult times. And often difficult times that for us as sort of technical observers would say are outside of their control. There's shocks, there's, you know, geopolitical developments outside of the country. So engagement is a really tricky thing to manage. Again, the financial markets are always somewhat engaged, but the wider public, they engage at exactly the moments that it's tough. And then lastly, education. I do think education plays an incredible role. It wasn't referred to, but you know, Switzerland does benefit from a very engaged population who are attentive on lots of issues, including voting issues, which many countries would also consider to be you know, a nice luxury to have. And so I don't think this is the job of the central bank. I should be very clear on this. You know, there's ministries of education, there's national curricula, but certainly this issue of financial and economic literacy can certainly help, and central banks do play a supporting role in that. But so let me go back and summarize. Whenever I talk about communication with the general public, I want to make it very clear. I am not talking about this as a substitute or a replacement for the traditional communicating your messages to financial markets, but I think it's a complement, and I do think in the last decade, central banks, many of them, have made a lot of progress. I think of the Bank of England's layered content as a way of sending the same message, but to two different audiences at the same time. But if you pushed me on what you communicate to the public, I'd say the key thing is just keep driving home the core message, which is inflation target, we will get there, we're doing everything we can to get there, and then you can build little extra bits on as you go.
Thank you very much. Captivating. It actually sounds almost like a charter of a communications department of a modern central bank, or a fledged central bank. Great, thank you. Let's now turn to the last area that featured in the introductory remarks, and that's digitalization and maybe the future of money. Professor Sekine, so do you see the rapid advance of technology and digitalization, is it more as a shock amplifier that we should be worried about, or do you think we can harness it in some partly positive way, or how do you think it's going to affect the transmission of monetary policy? Is it, yeah, go ahead.
Well, I think that's so. The jury is still out. We don't know as yet what is going on. But what I can say is, well, at least that's so. We already have some sort of things already without fully digitalized world. So let me just talk about, well, what I have in my mind is, well, we have already observed that the digital bank, bank run in the form of the Silicon Valley banks, in a sense, without CBDC, without stable coin whatsoever. At the time of the Silicon Valley banks falls, there is a so-called digital bank run happen. So that means that well, for me that's well, even without fully digitalization, we already step in that sort of concern in a sense. And this is not effectiveness of the monetary policy, but much more related with financial stability side. Irrespective of, well, the progress in the digitalization, we need to look at the financial stability in the new era, because we have already observed one, at least, example in the world. And regarding that, the effectiveness of the monetary policy thing is, well, what I can say is at the initial stage of this digital currency debate, so some of the academics or scholars, not me, by the way, is talking about that. So, well, the digital currency, introduction of the digital currency is, well, very good thing for us. Because, well, if we can fully digitalize the currency and we can abolish that banknote, then well, what we experience in Japan is we can get negative interest rate further down. So that is the kind of thing that some of the academia talked about. But for me, as a practitioner, I don't think that there is any possibility to get rid of the banknote, at least in Japan. Well, think about that. So in Japan, it's a very natural disaster country, earthquake, typhoon, whatsoever. But at the time the people really use banknote rather than digital form. And as a consequence, Bank of Japan itself is saying that we will provide the banknote, at least there's public demand. And what I say is there is no possibility, at least for Japan, that the public demand of the banknote disappear. So if that is the case, zero lower bound is still there. So that means that I don't think that it's going to happen. We can further experiment the much more negative interest rate as a consequence of the digitalization of the currency. So that means that I think that effectiveness of the monetary policy will not so much change in the future, at least for the time being. That's my expectation. So thank you very much.
Thank you very much, Professor Sakine, and thank all of you, all the panelists for excellent contributions in discussion. Unfortunately, we're running out of time, so I've been informed that we will not have the Q&A session, unfortunately. We'll also abandon the blitz round of questions that I have prepared. But I would like to thank again. I think some of the themes that ran through this panel could echo the following words. Scenario analysis seems absolutely crucial, although some practical aspects of how to communicate that externally still needs to be worked out or experimented with. The communication leads to premiums, to risk premiums, so you should be really worried that these experimenting may have costs, long-term costs, and costs in the long-term yield curve. I think we also, everyone spoke about importance of robust policy, what I could call, or not, I think it was not me, but policy of least regrets, a monetary policy in a way. And it's a risk management approach to monetary policy. It's very important path towards that. And finally, it seems that there's a belief that we should be less tolerant to shocks and maybe less tolerant to flexible regimes, and going back to basics and following the keynote speech of Athanasios Orphanidis. So with that, I would like to thank the panelists again very much, and I would like to invite Governor Ishmetov to give concluding remarks, please. Thank you.
Distinguished governors, colleagues, professors, ladies and gentlemen, as we bring today's dialogue to a close, let me begin where I started in the morning with the big thanks. Thank you for coming to Tashkent. Thank you for sharing your experience, your knowledge, and giving us discussions that was both intellectually demanding and genuinely useful. This dialogue matters for us for a particular reason. It is the first time the Central Bank of Uzbekistan has convened a forum of this kind. We did not set out at another conference to the crowded calendar, but we set out to create a platform for honest policy exchange, a place where policy makers, international experts, scholars could sit at one table and share their knowledge and their views. This morning I asked to bring the most difficult questions, and this is precisely what I can say with some confidence, that this conversation should always be like this. Let me offer 3 reflections from what we discussed today. The first is that about the world which we are now living in, across remarkable differences, across all comments. The one message emerged with striking consistency that we are living in a new environment with central banks operate quite in different environment with lasting volatility. And it's becoming permanent feature, unfortunately. And the second follows directly from the first, that now the central banks can, no central bank can navigate its strengths on its own experience alone. In the age of fragmentation, I think what we have to do in response is exactly the opposite, is the more dialogue, more exchange, and stronger cooperation. This is the thought I most wanted to leave you with, because it is the reason we gathered today. Uncertainty may be global, but learning must be continue to be collective. And the thought about digitalization today confirmed that many of us suspected but had not yet said that plainly to one another that digital transformation is no longer a peripheral concern for central banks. It's moving to the center of how money moves, how financial systems functions, and how monetary policy itself may one day operate. Dear colleagues, throughout the day, what struck me the most was not where participants agreed, but how much we can learn from each our experiences with different views. And central banks brought practical policy experiences. International financial institutions can continue to contribute to a global view across countries and regions. And most importantly, academic colleagues can continue to challenge us to think more deeply, question assumptions, and look beyond immediate policy horizons. In a world that is becoming more complex, no single institution has all the answers. Central banks cannot rely only on central banks. Policymakers need researchers, researchers need practitioners, countries benefit from learning from one another's successes and mistakes. That's why the idea behind this dialogue can be expressed in 3 simple words: let's continue think together. We hope this forum becomes a place where central banks, academia, and international institutions continue to meet, exchange ideas, and learn from one another. In Tashkent, if Tashkent can contribute to this mission, we will consider this dialogue a success. Thank you very much. Rahmat.
Thank you very much, dear colleagues, professors, and guests. Now we invite you to the photo zone for the group photo.
May I kindly ask the guests whose table numbers have been designated for the group area, for the photo area. All other guests are kindly requested to remain seated as we continue with our next session.